Core AI trading strategies combine advanced machine learning and quantitative finance to generate alpha across markets. Statistical arbitrage uses ML to detect pricing inefficiencies, while AI-driven momentum models capture trend persistence. Reinforcement learning enhances mean reversion by optimizing dynamic trading policies. AI-augmented factor investing improves signal selection and weighting using nonlinear models. Global macro strategies leverage deep learning to forecast economic trends and cross-asset relationships. Multi-asset portfolio optimization applies AI for dynamic allocation and risk control. Together, these approaches enable adaptive, data-driven trading systems that improve prediction accuracy, execution efficiency, and portfolio performance in complex financial environments. 1. Statistical arbitrage using machine learning. Statistical arbitrage using machine learning is one of the most widely adopted AI trading strategies in modern quantitative finance. It focuses on identifying short-term pricing inefficiencies between related financial instruments, such as pairs of stocks, ETFs, or derivatives, by analyzing historical relationships and real-time deviations. Traditional statistical arbitrage relied on linear models and simple correlation metrics, but machine learning significantly enhances this approach by uncovering nonlinear patterns and complex dependencies across thousands of variables. Models such as random forests, gradient boosting machines, and deep neural networks are trained on large datasets that include price movements, volume, volatility, and even alternative data sources. These models continuously learn and adapt, improving their predictive accuracy over time. This strategy typically involves constructing long and short positions simultaneously, betting that mispriced assets will revert to their statistical equilibrium. Execution is often automated and occurs at high frequency, requiring robust infrastructure and low-latency systems. Risk management is crucial, as model overfitting or structural market changes can lead to unexpected losses. Machine learning also enables dynamic feature selection, anomaly detection, and real-time signal generation, making the strategy more resilient. Overall, statistical arbitrage powered by AI transforms traditional pair trading into a highly scalable, data-driven approach capable of processing vast amounts of information and executing trades with precision, forming a cornerstone of many leading quantitative hedge funds trading operations. 2. AI-driven momentum trading. AI-driven momentum trading builds on the classic financial principle that assets which have performed well in the past tend to continue performing well in the near future, while underperforming assets tend to keep declining. Artificial intelligence enhances this strategy by improving signal detection, timing, and risk control. Instead of relying solely on simple indicators like moving averages, AI models analyze high-dimensional datasets including price trends, trading volumes, macroeconomic indicators, and alternative data such as news sentiment and social media activity. Machine learning techniques such as gradient boosting, deep learning, and time series models help identify subtle momentum signals that may not be visible through traditional analysis. These models can also adapt to changing market conditions, distinguishing between true momentum and noise. AI-driven momentum strategies often operate across multiple asset classes, including equities, commodities, and currencies, and can be implemented at various time horizons, from intraday to long-term trends. Execution is typically automated, allowing for rapid response to new signals. Risk management is enhanced through dynamic position sizing and volatility forecasting. However, challenges include crowding effects, where too many traders follow similar signals, and sudden reversals that can lead to losses. By integrating advanced analytics and adaptive learning, AI-driven momentum trading offers a more robust and scalable version of a well-established investment strategy. 3. Mean reversion with reinforcement learning. Mean reversion with reinforcement learning represents a sophisticated evolution of a traditional trading concept. Mean reversion assumes that asset prices tend to return to their historical average over time, creating opportunities to buy undervalued assets and sell overvalued ones. Reinforcement learning, RL, enhances this approach by enabling trading agents to learn optimal strategies through interaction with the market environment. Unlike supervised learning, RL does not rely on labeled data, but instead uses reward signals to guide decision-making. The agent observes market states, such as price levels, volatility, and order book dynamics, and takes actions like buying, selling, or holding, with the goal of maximizing cumulative returns. Over time, it learns when deviations from the mean are likely to revert and when they may persist due to structural changes. RL models can incorporate transaction costs, risk constraints, and execution timing, making them highly practical for real-world trading. This approach allows for adaptive strategies that evolve as market conditions change. However, training RL models is computationally intensive and requires careful design to avoid overfitting or unstable behavior. When implemented effectively, mean reversion strategies powered by reinforcement learning can dynamically adjust entry and exit points, optimize trade execution, and improve overall profitability, making them a powerful tool in the arsenal of advanced quantitative trading systems. 4. Factor investing enhanced by AI. Factor investing enhanced by AI combines traditional asset pricing theory with modern machine learning techniques to improve portfolio performance. Factor investing is based on the idea that certain characteristics such as value, momentum, size, quality, and low volatility can explain differences in asset returns. AI enhances this framework by identifying new factors, refining existing ones, and dynamically adjusting their importance over time. Machine learning models analyze vast datasets that include financial statements, market data, and alternative sources like ESG metrics or consumer behavior. Techniques such as regression models, neural networks, and clustering algorithms help uncover nonlinear relationships between factors and returns. AI also enables more precise portfolio construction by optimizing factor exposures while managing risk and transaction costs. This leads to more efficient diversification and improved risk-adjusted returns. Additionally, AI can detect regime changes in markets, allowing the strategy to adapt when certain factors become more or less effective. However, challenges include model interpretability and the risk of overfitting, especially when using complex models. Despite these challenges, AI-enhanced factor investing offers a powerful way to modernize a well-established strategy, making it more responsive to evolving market conditions and capable of capturing a broader range of return drivers. 5. AI-powered global macro modeling. AI-powered global macro modeling is a strategy that uses advanced analytics to predict and capitalize on large-scale economic trends across countries and regions. Traditional global macro investing relies on human interpretation of macroeconomic indicators such as interest rates, inflation, GDP growth, and geopolitical events. AI transforms this process by automating data analysis and uncovering complex relationships that may not be evident to human analysts. Machine learning models process vast amounts of structured and unstructured data, including economic reports, central bank communications, and global news. Natural language processing is often used to extract insights from textual data, while time series models and deep learning techniques identify patterns and forecast macroeconomic variables. These predictions are then used to inform trading decisions across asset classes, including currencies, bonds, equities, and commodities. AI also enables scenario analysis and stress testing, helping investors prepare for different economic outcomes. The strategy often involves trading derivatives such as futures and options to express macro views efficiently. While powerful, AI-driven macro modeling faces challenges such as data quality, model complexity, and the unpredictability of geopolitical events. Nevertheless, it represents a significant advancement in global investing, allowing for more systematic, data-driven decision-making in a traditionally discretionary field. 6. Multi-asset algorithmic portfolio optimization. Multi-asset algorithmic portfolio optimization is a comprehensive AI-driven approach to constructing and managing investment portfolios across different asset classes, including equities, bonds, commodities, and currencies. The goal is to maximize returns while minimizing risk through optimal asset allocation and dynamic rebalancing. Traditional portfolio optimization methods, such as mean variance optimization, rely on simplifying assumptions and limited data. AI enhances this process by incorporating a wide range of inputs, including historical returns, volatility, correlations, macroeconomic indicators, and alternative data sources. Machine learning models can capture nonlinear relationships and changing market dynamics, leading to more accurate estimates of risk and return. Optimization algorithms, such as genetic algorithms, reinforcement learning, and convex optimization techniques, are used to determine the best portfolio configuration. AI also enables real-time adjustments based on market conditions, improving responsiveness and resilience. Risk management is integrated into the process, with models assessing tail risks, drawdowns, and stress scenarios. Execution is automated, ensuring efficient implementation of portfolio changes. Challenges include computational complexity and the need for robust data infrastructure. Overall, AI-driven multi-asset portfolio optimization represents a significant advancement in investment management, offering a more adaptive, data-rich, and efficient approach to achieving long-term financial objectives. If you enjoyed this video, like and subscribe for more AI and finance insights.